Founders Forum, Episode 6.
Open your mind to a new episode of the Founders Forum, the podcast championing a free economy, sound assets, and blockchain solutions. Each week, your hosts, entrepreneur Cole Snell and economist Bob Murphy, interview pioneers and free thinkers to help you develop into the architect of your future.
Hello, everybody. Welcome to another episode of the Founders Forum. This week, Cole and I are going to be speaking with Caitlyn Long about many issues. She's an expert in blockchain technology and how it can be used in finance. But we also highlighted, just in case you're just listening to the beginning of this and you're wondering, do I want to listen to this episode? There's a fun part in here because Caitlyn had been one of the ones sounding the alarm on FTX and just leverage in the crypto space more generally. And we have a nice clip where she was on a panel with a certain someone whose first name is Sam. And anyway, it's good stuff. A little bit from Caitlyn's official bio page here, just so you know where she's coming from. She's the founder and CEO of Custodia Bank. That happened back in 2020 and it's still the case today. She has been on the Wyoming Blockchain Task Force, a gubernatorial appointee from 2018 through 19, and on the Wyoming Blockchain Select Committee from 2020 through 2023. She won the Markets Media Women in Finance Award for Excellence in Blockchain in 2016. And earlier, she had 22 years of corporate finance experience at Morgan Stanley, Credit Suisse, and Salomon Brothers. And she was a managing director from 2001 to 2016 in the corporate finance world. So as you'll see, as we get into this, Caitlyn has a lot of experience in Austrian economics and, again, another passion of Cole and mine. And so this is a fun conversation. So here we are, our conversation with Caitlyn Long. Well, Caitlyn, welcome to the Founders Forum.
Thank you. Good to see you again. It's been a little while.
Yes, it has. So I was telling Cole about you and sharing some clips, and we'll get into some of this stuff in a minute. But before we get into more recent matters, maybe just to give some background for the listeners, you're fairly unusual in that you're a fan of Austrian economics, and yet you had a career with major investment banks. For example, you were at Morgan Stanley, I know. So can you just talk a little bit about what your journey was? Like, were you in the traditional corporate finance world and then you found Austrian economics, or vice versa?
Yeah, like so many of us took the Keynesian economics classes in college and grad school in my case as well. And then the 2008 financial crisis hit. And that's when I came across you and your work and went on a big intellectual journey of discovery, looking at everything from Austrian school on the one hand to MMT on the other. And in fact, I remember a debate with you and Warren Mosler at Columbia. It was probably about 2010 on Austrian school versus MMT. And it was really something you said really stuck with me, which is that the Austrian school approach to the world, which I don't 100% agree with, but I think it generally gets the following right, which is what you said, which is that it has a capital theory. There's a capital structure, that balance sheets matter. And it's so interesting because so much of the mainstream economics just assumes the balance sheet away. You can just keep issuing debt forever. And that really stuck with me because, of course, balance sheets matter. And most of us in this world don't think about balance sheets at all anymore because we've been trained really not to. Think about the entire tech sector and the internet. It was all about cash flow and not about balance sheet at all. And if the balance sheet doesn't matter, maybe is the way to conclude it until it's all that matters.
Well, it's funny. I'm glad to hear you. I appreciate those remarks, but it's especially gratifying because, as you can imagine, Caitlyn and Cole also, Cole, I debated this guy, Warren Mosler, who was one of the fathers of MMT, modern monetary theory, for people who don't know what that is. And he's extremely confident guy. He's very charismatic. I had to stop talking to him before the debate because he was going to convince me. And we had to go in there and fight. And he's just a super charming guy, real suave. And so a lot of MMT people are convinced that Mosler wiped the floor with you, Murphy. And I'll post something on MMT and they'll just post a link to the debate and be like, "This you, bro?" As if just showing that debate is evidence that I should just believe that. Yeah, it's funny. That's how sure they are that he. But I can at least say, well, Caitlyn Long, became an Austrian because of that. So if nothing else, then there you go.
Yeah, well, and again, a lot of it. I mean, the Austrians definitely got the inflation piece wrong, but in the short term. But what was so interesting is that pushed me to figure out why? I was so curious. Why were there predictions? And frankly, going back to 1971, there were predictions of hyperinflation and a dollar collapse in 1971. The same thing happened after 2008. Why is it that the Austrians have then therefore become viewed as, a broken record, and because they consistently get it wrong? And that really, they didn't get it wrong. It's just that, again, you got to come back to the balance sheet, which is what you said that really stuck with me. That the capital structure really matters, and the capital theory of the Austrian school was, I think, the one that made the most sense. The light bulb started going off because the balance sheet matters, and what I think the Austrians missed on hyperinflation, and they will continue to miss it until it actually does happen, and that is that we still have balance sheet left over. The U.S. was an equity funded economy up until 1968. In other words, all of the non-financial debt was financed by savings. And so we didn't, as an economy, lever up more than 1-to-1. We basically, people turned around and lent out their savings, but we were not having lending of more than savings. And so that's the way I define it as an equity finance economy. You can see it from the Fed's own data. Going back to 1968, from time to time, obviously from year to year, there'll be a little bit of a lag. But for the most part, the non-financial sector debt in the economy was essentially equal to savings in the economy. And then what happened in 1968? You started to see non-financial sector debt accelerate. And so there was more debt created than savings. And that pushed the final end of the last vestige of the gold standard in 1971. And then non-financial sector debt really started to take off, but not as much as, in those early years, because you actually had, Volcker at the Fed and the like. So you actually had some control. I mean, certainly the US was borrowing more than it was saving, but we started to get into a debt financed economy and from an equity financed economy. And then, of course, by the 90s and 2000s, it's just gone off the rails since then. And so now we're back to the whole question, does debt really matter? And, the MMTers will run around taking a victory lap until that's the only thing that matters. And, then finally the Austrians will be right. But I think it is important to kind of dig into those distinctions, because the Austrian, there's definitely, to your point, right? A lot of people will say, hey, you predicted hyperinflation in 2008 and it didn't happen. That doesn't mean you're wrong. It didn't happen then, but that's because we still have some balance sheet left over in the economy. We're still able to borrow. And there will come a time when the US dollar doesn't finance that incremental dollar of non-financial sector debt. And then we move to a new regime. I just don't know when that's going to be.
It's funny you say that about it's funny you say about the balance sheet. Like, so I got a PhD in economics from NYU, which, at the time I left was top 15, and got to that point and I didn't know how to read a balance sheet. And I don't mean like, you're probably thinking, like a real balance sheet no, I mean, just even theoretically, like, there's assets on the left side and what's on the, I had to go figure that out, talk to my buddy who was working at Moody's, just to be able to do stuff on fractional reserve banking at a theoretical level, just to get everything to line up and have the T accounts balance. So it's economists don't know anything about balance sheets, just period.
It's so true.
So and it's not surprising. Yeah.
Well, even those who are not economists, we all learned it in school the wrong way, right? So yeah.
And it's almost even more frightening that founders, startup entrepreneurs, haven't been taught balance sheets. What is about? So Caitlyn, it's really an interesting question. A lot of the viewers, and we're in episode number 6 right now. And so we don't really know exactly who our viewers are. We have a pretty good idea. We're starting to kind of flesh that out a little bit. We do know the title of the podcast is called Founders Forum. So we intend to attract founders. We kind of believe that the lifeblood of economy are startup businesses and the success or correction of kind of said business or whatever market that they're in. When you were talking about balance sheets, how would you be able to take everything that you just kind of spoke to at that macro level about inflation and the Fed and kind of break that down, say, to a founder, understanding that a balance sheet for the country or a balance sheet for a startup business is kind of the same thing? And that's the good thing about balance sheets. It's about balance. What could a founder do, a startup founder do to get off on the right foot in relationship to their balance sheet?
Well, first of all, pay attention to it. Again, so especially in the tech world, there are so few people who do pay attention to it. But second of all, it all has to do with when you start a business, you will not survive if you don't generate a return on capital that exceeds your cost of capital, period. Simple concept. Got to generate returns in excess of your cost of capital. Otherwise, you'll eventually hit the wall. Now, what has happened with how screwed up the debt markets are, which are not even remotely free market prices anymore, right? We've got a giant central bank and a giant banking system that are sitting on those debt markets, and no one really knows what interest rates would be. I mean, this is just right out there for everyone to see that you've got massive amounts of quantitative easing and quantitative tightening that are taking place that are not free market phenomena. So we don't really know what interest rates would be in the absence of all of that. And so how does an entrepreneur make the economic calculation of what's my real cost of capital and how do I think about what's the return of capital on capital that I should be targeting? And so, that's, to me also, this is one of the things as I go back, it was an aha moment. Why is it that in the 2008 financial crisis, the entire real estate industry miscalculated in the same direction at the same time? Okay, massive overinvestment in housing. Why? Usually in a market, you have buyers and sellers, and the price is the marginal price at which the buyers and sellers meet. But that didn't happen in 2008. And, we've seen it in many different examples where entire industries miscalculate at the same time. And that's because they're taking the wrong cues. So back to your question for founders, it's really tough. You just have to be very aware that interest rates are probably a lot lower than they would be in a free market right now. And so think about that when you think about targeting your return on capital. You should probably be targeting a much higher return than you think you need to be because your real cost of capital is higher than you think it is.
Yeah, I can really appreciate that. I was in the food industry for a very long time where cost of capital was very, very high. Margins were very, very low. We had a saying in the food industry where sell it or smell it, understanding that our inventory and the thing that we were selling was perishable. So, it kind of had to go. And so then I kind of realized, pretty quickly the importance for founders to choose the right sector or the right industry to go into. And now here I am in the financial industry. I imagine coming from food where you had, these, just as an example, you had these, massive payrolls and you had logistics and perishable inventory. And now I'm in the financial industry and I've been quite successful in the financial industry because I've brought the same energy and urgency that I brought from the sell it or smell it industry into the financial industry. So how important is it for a founder? Maybe that founder just had this energy and this zeal. I don't want to have a job. I don't want to be an employee. I don't want to work for the government. I want to go out there and do something. I want to go create something. I want to find something. I want to found something. How important is the sector? Because if I had to do it all over again, I would not have spent an hour of the 25 years I was in the food industry. I fell into the financial industry like 5 years ago, and where have you been my whole life? So how important is the sector? Is it important to follow the passion, or is it important to follow the profits?
Well, you have to do both, right? Obviously, as a founder, you've got to be very passionate. Mm-hmm. It's very difficult to start up any business, but especially start up one from scratch. You need a lot of grit. But this gets to something Bob can talk about, which is the Hayekian triangles, right? The longer term the payback period on your investment, the greater the likelihood that if you miscalculated, you're going to be off massively. Okay, so, but this is also something that you see in the economy regularly, that people are very short-term focused because that's the incentive that's been placed out there in front of them. And for the very long-term focused businesses, the very deeply capital-intensive businesses like mining or, building a nuclear plant, right? You're looking at 30, 40-year investment periods on something like a nuclear plant. The chance that you're going to miscalculate because interest rates are off is very high. And it's just like physics, right? Think about a golf shot, right? Just a small miscalculation, the longer the golf shot is, the farther away from your target it's going to be, right? So people tend to therefore focus very short term. And, you get a massive underinvestment in things like maintenance. And boy, we sure see it in the infrastructure in the United States, right? We're just massively underinvested in maintenance because it's not sexy, right? Well, it also takes it's a long-term investment in in CapEx, and businesses that are CapEx intensive tend to be less favored because the miscalculations that can occur are massive. And then you see what happens, for example, in the housing sector, all the home builders going into 2008, you saw a lot of bankruptcies during that time because they overinvested in land, very long-term payback in those investments, and then they lost their shirts. Whereas those who are investing in shorter-term industries with shorter-term paybacks are less likely to have a big problem with miscalculation that we're talking about here.
Let me circle back to something, because we were trying to figure out the optimal time to plug in this little clip.
Yeah.
And so you mentioned leverage a minute ago. And so I think, you had a famous exchange. So I'll just set this up. We'll, play the clip for the viewers in case they missed it. And then, I want to ask you about it. So you sort of, it's become infamous in certain circles at this point that you were on a panel with Sam Bankman-Fried of FTX. And it was 2021 this occurred? Yeah.
2021, yes. It was spring 2021, yeah.
Yeah. The specific issue was leverage. And so you gave it, and you even mentioned, the Austrian school. And so a lot of us were cheering when this circulated around, and then he comes back. So why don't we just for the listener, we'll play the clip here, and then I just want to get your reaction on it.
Satoshi gave us money that isn't debt. And philosophically, why would you put debt on something? I like to use the phrase, a fool and their leveraged Bitcoin are soon parted. Again, a fool and their leveraged Bitcoin are soon parted. And the excesses that we've seen in this bull market are coming from a lot of leverage that didn't happen in the previous bull market, right? We had the ICO issue in the previous bull market. This bull market, it's leverage, right? We've seen more volatility. And one of the big issues with that is that even those of us who are not leveraged have the downside of the fact that the price is more volatile precisely because of the running of stops in these leveraged drawdowns, which we've just seen over the last month. It increases the cost of capital for everybody in the industry when Bitcoin's price is more volatile as a result of the impact of leverage moving it around. Avanti is fundamentally committed to not using leverage. And if you're interested in understanding why, philosophically, I really would encourage you to go read Mises. Go understand the difference between commodity credit and circulation credit. Commodity credit is absolutely fine. It's not leverage. Going one-to-one leverage is fine. Anything that is circulation credit that goes above 1 times leverage, in other words, certainly 100-to-1 leverage is is 99% circulation credit, right? That is creating claims to the underlying out of thin air. It is fractional reserve banking. And we are fundamentally committed to not doing that. It is ultimately a commitment to solvency instead of liquidity. And what we've seen in this bull market is a lot of folks are obsessed with liquidity. Satoshi didn't create anything that was designed to be leveraged and really didn't care about liquidity. One of the biggest takeaways that I have from this conference is what Nick Szabo said yesterday, when he said liquidity is a nice to have for a store of value, but not a necessity. You need to be able to use it when you need it, but do we need all this daily liquidity that's driven by trading? Go back and listen to Nick's speech and go read your Mises and learn about circulation credit.
Sam, do you agree?
Look, you can take the position leverage is bad. I don't believe that, but one could believe that. It's not a crazy thing to think. However, were you to think that, I think you'd probably also have to be willing to sacrifice more than most people realize in order to get there. I think you would have had to sacrifice the majority of the growth that the industry has had to date if you were to make that trade, and that might be worth it, right? If you think that it is very bad to have leverage in the system, that might be a trade-off worth having. But you can't just look at the drop from 60K to 40K and blame it on leverage without remembering that the run-up from 10K to 60K involved leverage
Absolutely,
as well. And we ended up higher than we started. And so just think about what you're throwing out, with the bad parts. Think about the collateral damage.
Well said.
Okay, so there you have it with Sam Bankman-Fried just sort of confidently talking about, I'm missing out on all these opportunities. Leverage is good. And so obviously you're now vindicated in hindsight, but I'm just curious, at the time, like, were your spidey senses going off? Like, did you know
Oh, yeah.
something is so? Yeah, go ahead.
Well,
You want to say.
Yeah, I've been writing about this publicly since 2018, that Bitcoin and leverage don't mix, crypto and leverage don't mix. And it's a really simple concept. These are highly volatile assets. It's especially Bitcoin itself it really is like a commodity, and it's got a cycle. It's got a 4-year cycle. And depending upon where you are in that cycle, the price is going to be volatile. It's just like any other commodity. And then the other piece of that is that I also knew there's no lender of last resort. Okay. By the way, Sam Bankman-Fried, one of the last things he did was talk about DC Blockchain Week, where he made a pitch to the DC policymakers to allow the crypto industry to be bailed out by taxpayers. And by then, I've long known that this thing was going to blow up, right? I mean, it predicted it in 2021, but I started to see a lot of other behaviors that just didn't make sense. My spidey senses were especially up in the spring of 2022. 2022, where he started to just buy assets regardless of the price. That's what Ponzi schemes do. And then the next piece is there was another instance where he canceled the shares of Voyager that were publicly listed on the Toronto Stock Exchange because in order to sort of keep the Ponzi going, allegedly, he bought in Voyager, which owed the money. And because he tripped over the 10% disclosure rule on the Toronto Stock Exchange, it would have required FTX to have disclosed its financials publicly. And so he just canceled the shares. You never do that. You never cancel shares in a business. And so, I started seeing things like that and started commenting to people and of course I knew a lot what was going on behind the scenes. We knew way back in 2021, where did this FTX come from? You can see from the blockchain. Blockchains are transparent, for better or for worse. You can see what's going on, and people knew something was off. Where was all this money coming from to throw these huge contracts at sports stars and celebrities and throw in advertising, when you could back into some basic back of the envelope estimate of how much money they were making. And it was pretty clear they were spending a lot more money than they were making. And now it seems pretty obvious that indeed was the case. So, because it was customer funds allegedly, and that's the thing that makes sense. And so now, the rest of the industry has picked up on some of these things that we had picked up on. And those of us who've been around know how to separate the wheat from the chaff. What's so interesting is how far FTX got into the traditional financial system. Just last week, the Inspector General of the FDIC announced that in their I think it's a semi-annual report, that 11 U.S. banks may have committed wire fraud involving FTX. 11 U.S. banks. That's incredible. And I didn't know that it was that many. There have been allegations and class action lawsuits against a couple of the banks that allowed the funds allegedly that were supposed to be sent to FTX to be sent to the sister company hedge fund Alameda instead. That is a big no-no. And the banks didn't catch it, but it wasn't just a couple of banks. Apparently it was 11 banks. Wow.
I really appreciate one of the things that you said about buying assets regardless of the price. I have an actual, and I love that story. I mean, thank you for sharing that. I mean, what a real world example. And, thank you for your spidey senses. Wish all the people that FOMO'd their way into FTX had the same spidey senses. But I guess here we are. One of the real world stories about buying assets regardless of price was I lived most of my time in the Bahamas, between Bahamas and Miami. And I was sitting at Old Fort Bay about 3 or 4 weeks ago with a friend having lunch. And my friend works in the financial industry and he's well connected in the Bahamas. And I said, which was the house? And we're sitting where the cabana is. I said, there's these houses over kind of looking at the beach. And I said, which is the house where Sam's parents lived? And he kind of pointed. He said, that one right there. And it's like the big house overlooking all of like Old Fort Bay, like this. And I go, interesting. I go, so what would something like that go for? And he said to me, and we're just casually talking. He's like, oh, well, I'm not sure what the fair market value for the house is, but I know that Sam paid about $5 million over asking. I go, really? And it was just like a casual kind of conversation. The seller didn't want to sell, and Sam just kind of said, I'm buying this house from you. Give me the most ridiculous price that you can come up with. And yeah, so there you go. I mean, that's like to your point about, and good for you for figuring this all out.
Well, and it wasn't just him. So to be fair, as we were talking earlier, I started warning back in 2018 and had debates with some of the other characters, criminals and grifters, shall we say, from this industry. I won't name them, but it's not difficult to look it up, where I was warning the leveraged lenders in this space. And to me, lending against crypto, it's a volatile asset to begin with, and then it has no lender of last resort. So the moment you start engaging in fractional reserve banking, which of course they all did, they were insolvent, and it's just a matter of time before that insolvency becomes recognized. Okay, so that was an easy prediction. Unfortunately, a lot of others did not understand that. They didn't have enough grounding in real economic principles to be able to understand that. But you'll find a number of instances where I was calling out some of these, not necessarily criminals, but people who just really massively levered up their balance sheets. And when the big correction came, as inevitably it was going to, as Misa says, the moment you get yourself into a fractional position, you are insolvent. It's just the market might not realize it until the correction comes. And all the correction is revealing the insolvency that was there all along. And it was funny, with one of them, I won't name names here, but it's easy enough to go find this. With one of them, one of the things that I learned working with my home state of Wyoming, I grew up in Wyoming, spent 30 years on the East Coast, and then moved back in 2019 to Wyoming, helped get the blockchain laws set up in Wyoming. And I learned from one of the people in Wyoming that there was a Supreme Court case that deemed rehypothecation to be felony fraud. And I thought, wow, how come I've never heard of this, right? Because Wall Street rehypothecates all the time. That word is in your, brokerage firm agreement. It's not difficult for you to go see it. It's just that most people don't know what it is. And so their eyes, if they bother to read the agreement, will just glaze right over it. But that basically means that your brokerage firm can take your shares of stock and lend them out to multiple people. Okay. So in Wyoming, there's a Supreme Court case, Smith v. State, that says that is felony fraud. And once I learned that, I pointed that out. And then one of the early leveraged blockchain lending companies that was one of these high flyer VCs, a lot of VCs were supporting it, investing in it, super rapid growth. And then I pointed that out, and guess what the CEO did? He stopped serving clients in Wyoming when he learned that. I thought, yay, protecting the Wyoming folks from, losing their shirt. And eventually, of course, everyone in that company lost their shirt. Everyone who had mostly Bitcoin, but other crypto with them in their earn product that was designed to pay yield. Let me close this discussion by pointing out one of the people who helped me really learn Bitcoin, Andreas Antonopoulos, likes to say Bitcoin is a disinflationary asset. You don't need yield. The inflation rate of Bitcoin is, I think, 1.2% right now. It's roughly the same inflation rate of gold. That is far less than the nominal inflation rate in most economies in the world. Ergo, you come out ahead just by owning it. You don't need to leverage it and take counterparty risk to earn some yield on it. And I'm consistently dumbfounded by folks who really don't understand that very basic concept and trying to educate them, because a lot of folks lost their shirts without understanding that basic concept. And these highly leveraged alchemists who tried to apply Wall Street alchemy, Wall Street, of course, being backed by the full faith and credit of the US government implicitly, because there is, the Fed put, so to speak. There is the put back to the taxpayer from the bailouts that we saw in 2008. And, the repo market, by the way, has been bailed out a couple of times since then. Okay, this keeps happening. The traditional financial system is not stable, and we know why. But those who brought that alchemy to crypto and tried to apply that alchemy to crypto have had their heads handed to them. And thank goodness, and good riddance to all of them.
Well, yes, thank you for that. And let me just add a little bit for some of the listeners in case they're not following the train of argument. So Caitlyn here has been alluding to the Austrian theory of the business cycle. She mentioned Mises and Hayek. And so one component of that is that, in their view, what causes the standard boom-bust cycle in market economies is what's called fractional reserve banking, namely that, as everyone knows, you give $100 to the bank, you think you've got it in your checking account, and they lend some of that out. And so for people who never thought it through, like, banking doesn't need that to function. That's just the way we're taught that it needs to be like that. It doesn't need to be like that. Like you can have, and this ties in, Caitlyn, what you're saying about debt versus equity financing. So am I right? Because you're the CEO and founder of Custodia Bank.
Mm-hmm.
Is that word like a play on custodian?
Yes, it is. Yes, indeed.
Okay, so do you maybe just want to talk a little bit about, because this is stuff that Cole and I are really interested in as well, that using blockchain with where the digital assets are backed up by things 100%. So you just maybe speak a little bit about what you're doing with Custodia?
Sure. Well, it's a Wyoming chartered special purpose depository institution designed to be a non-lending bank for one simple reason. Well, a couple simple reasons, but one of which is that the FDIC wasn't willing to insure de novo bank applicants that were involved in digital assets. We tested that theory. We did apply for FDIC insurance, and we got the answer through their draft process. Essentially, 18 ways from Sunday, hell no, which is exactly what we expected, because the FDIC had been cracking down on banks in the previous bear markets of crypto. They were cracking down on traditional banks that were serving the crypto industry. And in some ways, they were not wrong, by the way. And what I'm alluding to is the traditional fractional reserve banking lending model is you borrow short and lend long, right? You have demand deposits and you turn around and take those demand deposits and loan them out in a car loan or mortgage. And you just basically pray that not every demand depositor wants their demand deposits back at the same time. And because if you do, then you end up with an It's a Wonderful Life type bank run, right? We just saw that happen at a couple of the banks.
I gave you money to marry. Oh,
yeah, exactly. And we just saw that happen.
I had to do my impression. Sorry, go ahead.
Yeah. We just saw that happen at a couple of the banks that serve the digital asset industry. They had classic bank runs. And in one case, the case of Silvergate, they had a $715 million write-down on a fixed income portfolio because they got whipsawed. Interest rates had gone up since they'd bought those securities. So the mark-to-market value of them was below what they paid for. And they had to realize that loss in order to raise funds to pay off the depositors. Now, thankfully for the depositors, they all got their money back, but the shareholders of the bank obviously took a big hit. And that $715 million write-down was more than the bank had earned since 2013. So you can see how that can go very wrong. And so here's the problem. Because the digital asset industry moves that fast, literally a bank that is serving it can see its entire demand deposits withdrawn within the span of hours. We're talking about intraday, not even overnight. And so there's one and only one way for a bank that services that industry to handle the bank run risk, and that is to sit in cash. It's not even good enough to sit in T-bills, because T-bills, it takes a day to settle the sale of a T-bill. You can get intraday financing for those. And in fact, there are intraday financing facilities that the Fed offers to banks. And then, of course, the repo market, if you're one of the big players, you can get intraday repo financing. But here's the problem. The settlement, again, for all that, it really, if you're posting the collateral, if that collateral has to be liquidated, it's next day settlement, because T-bills settle next day. So what you really need in order to ensure that you're not ever going to have a situation where the customer can't get their funds back when they demand it, and these are demand deposits. Remember, you're supposed to be able to get your demand deposit back immediately. You really need for the bank to be sitting 100% in cash in a Fed master account. That's the only way to handle how fast things can move in the digital asset industry. And it's interesting, last week, there was a joint statement from all three federal bank regulators essentially saying to the banks, you got a lot of liquidity risk if you're going to service this industry, and you darn well better make sure that it doesn't spill over into the other parts of your business. And so, wink, wink, the implicit guidance that the three federal bank regulators gave to the banks is sit 100% in cash. Well, where have we heard that before?
From the Austrians? Is that what you're going with?
Yeah, but it's interesting, Bob, because that's not the reason, of course, that they're saying that everyone should sit in cash, but it's so that the bank should sit 100% in cash and not lend it out and play the borrow short and lend long strategy of a traditional bank. But it is the reality of what the bank regulators guided to last week. They said, look, you've got a lot of liquidity risk. They don't want the banks to be borrowing in the broker deposit markets. They specifically even said that. They also don't want the banks to be borrowing from the federal home loan banks, which are supposed to be there to support the mortgage market, right? So we saw some real spillover into some of the backup liquidity markets from the bank runs that took place back in December. But let me back up and underscore, all this was predictable. All this was foreseeable. And the banks that were taking that risk were, basically putting the deposit insurance fund at risk. And so again, back to why did Wyoming create the special purpose depository institution charter? Well, because FDIC insurance wasn't available. And I've repeatedly publicly said in a couple of different contexts, you really don't want the core of the traditional financial system to be exposed to assets that move this fast because of the settlement risk, right? And another example that I can point to is the President's Working Group about 18 months ago released a recommendation that said that only insured depository institutions should issue stablecoins. And I very publicly said, no, that's not it's the opposite. You don't want insured depository institutions to issue stablecoins for exactly this reason, because they're going to turn around and do fractional reserve lending. And then when there is a withdrawal within the span of hours, the bank's going to experience a bank run, and it could end up failing as a result. It's the exact opposite. You only want ring-fenced banks that have 100% cash to back customer demand deposits, in addition to the capital that they're required to hold to be able to take this kind of risk. And so now an interesting question has arisen, which is, all right, basically the anti-crypto, and by the way, I agree with a lot of the anti-crypto philosophy. That should be really clear. Anybody who's a criminal or a scammer or a highly leveraged business model should be flushed. But that anti-crypto group in Washington, D.C., which is resurgent and has taken power right now in terms of policy in the Biden administration and across the whole executive branch, they're not entirely wrong, but they threw the baby out with the bathwater. So now what's going to happen if they're really intending to completely debank the industry? We don't know yet, but certainly there's some indication that they want to achieve that. And if indeed that is achieved, what are they going to get? The very thing they fear. These assets that move so fast because they settle at essentially the speed of light are going to infect the traditional banking system, and the regulators are going to be playing whack-a-mole, and it's just going to repeat again the same problems that they've experienced here, where the traditional banking system has a lot more exposure to these assets than even the regulators themselves understood.
Can you maybe just elaborate? So this is all fascinating stuff, and it does dovetail nicely with some of the views that Cole and I have expressed on this podcast. But can you maybe just speak a little bit more? So, I mean, one thing is that we like to delineate that crypto is not the same thing as blockchain. Blockchain is more of the platform, a technology that crypto is one application of it. And yeah, what I try to get people to see too is a lot of these high profile, besides FTX, other failures of like certain stable coins, that there were things going on, like I guess it was May 2022 is a big thing. And how you could say it was fractional reserve banking if you want, or just people selling things and they didn't have it backed up one-to-one.
Correct.
And that's why they got into trouble. So suppose the politicians just stay out of it. Like, do you think there just be a lot more discipline? Like, did the market participants realize that was the issue, and then just going forward were more of them just, demand greater transparency? Or anyway, what do you think about that?
Yeah, it's interesting because I think you and I might differ a little bit on this based on the work that I'm aware of that you've done. I think, and this gets back to really, frankly, an old debate, a Mises versus Rothbard debate, right? Rothbard himself, he supported property rights, right? He supported court systems to help enforce property rights, but he also supported a ban on fractional reserve banking. I know there's a big debate, but in the Austrian school about between the free bankers really and those that actually want to ban fractional reserve banking. Okay, but if you take a really simple first principles approach, if you have a true commitment to property rights, there will never be fractional reserve banking. A true commitment to property rights ultimately means if you put your money into a money warehouse and you get a warehouse receipt back, and you have a bailment in that property right in your financial asset. I'll come back and talk about what a bailment is in a moment. But you never gave up title to that asset. If you never gave up title to that asset, then your bank cannot turn around and lend it out without your consent. And in most cases, most people wouldn't give consent because they know that if that asset gets lent out more than one-to-one, then their financial institution is insolvent. And again, now we're back to it was insolvent the moment they went levered more than 1-to-1, and it's just a matter of time before they actually fail. Okay, so people, I think, do understand this. Intuitively, let's talk about what a bailment is. A bailment is the same law that applies to valet parking for your car or a coat check. Okay, when you park your car at a garage and you get your ticket back, there's a big limitation of liability. Why? Because you never gave up title to your car. It's your insurance company that pays if something goes wrong. Same thing with your coat. That's your personal property. All you're doing is checking it out a coat check, which gives the coat check temporary possession of your property, and they have a duty of care, but they never take title to your property. So if we go back to a very simple first principles approach, where your financial asset is yours and you never give up title to it, even if you're temporarily giving up possession of it for somebody to safekeep it, you will never have that fractional reserve banking. So I realize, a lot of folks who have studied different schools of economic thought are I'm sure realizing that we're talking about the old Mises versus Rothbard debate here. And it's so interesting because one of my mentors with whom I debated for the better part of a decade on this very topic, he was on the Mises side of things, more of a free banker, and ultimately came around to agreeing, in part because he was watching what was going on in the digital asset industry. He came down on Rothbard's side of things, that you just don't want it at all. And so the question is, do you use the law to force that by banning fractional reserve banking, or can you do it in a more enabling fashion where you say, all right, the title to the asset is never transferred to the custodian unless those who want the asset transferred to the custodian decide to transfer it and then lend it out. But the moment they do that financial institution, if they lend it out more than 1-to-1, becomes insolvent. And it's a question of, at that point, who's ultimately going to get stuck with the loss.
Yeah, well, folks, we'll post some links on this if you want to get more reading, because I realize we're getting into some deep matters here. Incidentally, Caitlyn, my views have moved a little bit, so maybe offline I'll send you some things. But because now I used to think that Mises uses the term free banking.
Yep.
But I think he means something different from it by what, like Larry White and George Selgin mean by it. So in other words, like Mises, I think it's hands down thought fractional reserve banking causes the business cycle. And his concern was just, if you trust the government to regulate it, then, they're going to screw it up. Like better to, it's like Harry Brown once, some students were asking him about abortion, and he kind of diplomatically sidestepped it by saying, if you had the government be in charge of banning abortions, pretty soon men would be getting abortions, and everyone, moved on. But so in any event, that's putting aside, what you think should happen. I'm just guessing your predictions. Do you think there's going to be a lot more regulation, perhaps in the wake of the stuff we saw in 2022 in terms of, them coming down, and maybe you think some of that is actually, correct, at least in spirit?
Well, some of it is correct in spirit as long as it respects property rights. And again, that's where, the anarcho-capitalists would say, no, we don't want any of this. Let free markets work. But I come back to, if it's a property rights defining good fences make good neighbors kind of law, then you actually have the clarity of property rights, and a judge in the event of a dispute has a roadmap for adjudicating who's the legitimate owner of that asset. That is not something that even the most purists would disagree with. A true anarchist would. But that's not where I am by any means. And so, yes, it's interesting. Some of the purists don't like the work that Wyoming has done. They think it's dangerous because it is defining the property rights. But there was one of the Bitcoin OGs, Trace Mayer, who started buying Bitcoin at 25 cents. In 2009, 2010, I think, actually. Anyway, he worked with us in the state of Wyoming as a volunteer, all volunteers, to try to create the original laws back dating to 2018 that define what digital assets are under our existing legal regime in the United States. And we started with really simple things for the most part. It was digital assets are property. Well, if they're property, then if they get stolen, then theft laws apply, criminal law applies. And then another one is the commercial law status of digital assets. What does that do? That tells you what the rights and obligations of parties to a transaction involving digital assets are. And so a judge has a roadmap to determine who's the legitimate owner if there's a dispute. These are basic things. And frankly, they're very property rights respecting things. And I like to point out that Wyoming is such an interesting state to have been out front on this, because the Johnson County Cattle War was fought around 1890 in Wyoming. It's a famous, frankly, de facto civil war over the whole question of, will private property be respected? Did the ranchers have the ability to fence out trespassers? And that war was fought, and the ranchers won, and private property rights were respected. And frankly, there are still a lot of people who don't agree with that ultimate conclusion and want private property rights to be invaded. But that's, Wyoming has this deep history of commitment to literally good fences make good neighbors. Let's clarify, who owns the property. And so the anarchists would look at that and say, why are we bothering? And the rest of us will look at it and say, well, if you live on a seasteading platform, you might argue that there is no rule of law because no laws apply to you. But the 8 billion humans in the United States who live on land do live under legal regimes. And so to Trace's point, which I think is right, that if you don't have the law be backwards compatible with the technology, then the law becomes an attack vector on the technology. You don't want those two things to get deeply out of sync. And so as long as you take a property rights respecting approach to creating enabling regulations and laws, then I don't think it's inconsistent with Satoshi's vision of what Bitcoin was in the original Bitcoin white paper. Now, Satoshi definitely did not support fractional reserve banking. But again, like if you step back and say, well, if we're essentially defining this as property and saying that if you turn it over to a safekeeper, and if you can be in a regime where bailment laws apply, now you've actually taken care of the fractional reserve banking problem. Unfortunately, Wyoming is the only place in the United States where you can get a bailment on digital assets. And of course, the Wyoming Special Purpose Depository institutions are not yet operating, having, of course, been in a skirmish with the Federal Reserve, which is well reported on in the public. But it's far from over yet. So stay tuned.
I think it's important for the listeners to understand that when Bob and Caitlyn are talking about property, in a lot of cases, they're talking about your money, right? Your handful of money. When you hand it over, to a bank and you make a deposit, that's your money. That's your property. I just wanted to kind of make sure that they're not thinking about a parcel of land and in some cases.
Yeah. I mean, to Caitlyn's point too, that I guess, that's the way it's handled. I guess it goes back to, it was a British case that it was construed, in the British and then American legal traditions that, when you make a deposit at the bank, they treat it as it's a debt contract, not a bailment. Like when you give wheat to a silo, and this is the whole thing that, I guess that Caitlyn is getting at, is that's not how people think about it, for one thing, but also, and Jesus Huerta de Soto has a whole book on this stuff where, going back to Roman law and trying to argue that, the court cases went astray in terms of that British tradition. But yes, this issue of, again, just to make sure people didn't miss what her point was, that if you went to a coat check and handed it over and then you're eating dinner and you saw some kid outside wearing your coat, you might be upset. And if they said, no, we just knew that statistically we watch it and the meals take 45 minutes at the minimum, don't worry, we're going to have your coat back. We only lent that out for 30 minutes. We'll have it back, and as long as someone doesn't show up and present the ticket and we can't give the guy his coat back, then we're fine. You would say, no, that's not what I thought was happening here. So then that's how modern checking accounts work, at least the way they're regulated. And that's what gives rise to bank runs and so forth.
And brokerage accounts work the same way. So basically, your broker can take your security and lend it out. It's like the equivalent of a parking garage saying, all right, while your car is in our possession, we're going to rent it out to an Uber driver. And they may or may not have it back in time. And all we owe you back is the same make and model. We don't owe you your actual car back. Your brokerage firm's doing the exact same thing. They're lending out your securities for their own benefit. They're sticking you with the counterparty risk. And not paying you, by the way, for it. And if they go down while your securities are lent out, well, oops. And unfortunately, with the bankruptcies of Lehman and MF Global and Refco, you've seen the impact of some of those things. So again, if we get back to a property rights respecting regime, this whole concept of your valet parking garage lending out your car to an Uber driver while you're having dinner. And then, it may or may not be your actual car you get back. That is how finance works. But to your point, though, we shouldn't be making the distinction between personal property and financial property. It's all property. These are your assets. And we really should be going back to the old money warehouse concept of a bank and the way that custody used to work. It used to be you had a bailment on your gold bars and you got a warehouse receipt for those specific numbered gold bars. We've moved so far away from that in financial services. And a lot of it's not nefarious for what it's worth. A lot of it has to do with the technology limitations. It used to be everything was paper. It was easier to keep track because the actual paper was a bearer instrument, piece of paper. And if you didn't have the actual paper, then you didn't own it. And then we moved towards dematerialization and started to use ledger entries to evidence the property right. And then in the United States, I think it was 1986. Maybe it was 96, actually. I can't remember the specific year of the revisions to what's called Uniform Commercial Code Article 8 that got away from property rights respecting commercial law in securities and it created something called a security entitlement. So what you have is literally, Bob, as you said, a debtor-creditor relationship. You own an IOU. So what you have is a contractual right from your broker-dealer. You don't have the actual property. What you'd rather have in a court system is the actual property. And that's not what we have today. We have an IOU, which is a contractual right. And you're probably 3 layers away from where the actual title to your securities lies, which is with the depository trust company. There's literally all the Apple shares outstanding in the world, all the IBM shares, all the Facebook shares are in each case, there's one piece of paper sitting in a vault at the depository trust company. And by the way, during Hurricane Sandy, that vault got flooded, and so everybody had to go replace the piece of paper, which evidences all the shares that have been issued by those private corporations. That's where the legal title to your shares is, and you are a few layers down with different contractual IOU rights. But try to sue the depository trust company. You don't have what's called privity. You're 2 layers away, at minimum, from the depository trust company. So your rights, I've said this before, I think the greatest theft of property rights in the United States was when we went from direct ownership of shares to this indirect ownership model. And everybody then ended up getting an IOU as opposed to the actual property. And that was not necessarily done nefariously. Some people probably wanted it that way because it's centralized control. But it had a lot more to do with the technology limitations of the time. We are still, by the way, today, just digitizing analog securities. We are not natively issuing the securities on the internet in digital form. And when we move to native issuance of securities in digital form, a lot of the problems we just talked about, including the fractional reserve shares problem, are going to get solved. Just real quickly, there's a case called the Dole Food case, where the facts aren't important, but what is most interesting about it is there was additional consideration given in a M&A situation where Dole was sold, and the court said everybody needs to turn in brokerage statements to evidence how many shares you owned on that particular date. And it turned out when they added up all the shares that were evidenced by seemingly valid brokerage statements, it was more than 1/3 more shares than were legally issued. So the Wall Street bookkeeping systems created in their ledger entries more than 1/3 additional phantom shares. Think about the impact of that to mom and pop owners, the legitimate owners of the Dole Food shares. They had their pocket picked because all this fake supply flooded the market. And people who were buying those shares thinking that they were buying the real thing were actually buying one of the fakes. What did that do? Think about your supply demand curves back to your economics class. Microeconomics, by the way, I think was accurate. You push the supply curve out for something. What does it do? Regardless of the reason why the supply curve got pushed out, the price drops. And so people got their pockets picked in that situation. And it's just wrong. It's unfair. And it's a basic, simple concept. Let's move to an honest ledger so that we don't have our pockets picked. Everyone, I think, should be easily able to agree to that as a first principle. Let's have an honest ledger.
So this is fascinating. So yeah, that Dole Foods case did cross my radar when that was happening. It seems unbelievable that something so big that could be happening with all these reputable firms. I don't know if this was on your radar, Caitlyn, but Patrick Byrne, the guy from Overstock.com, he had been alleging for a while that what was happening is short sellers were coming in, hitting his firm, driving the price down, and he thought it was, and so he went out and he had a couple rounds. So I didn't go verify this, but this is what he would say on writing and public talks. And his claim was that because you'd say, okay, well, gee, it's a free market. If speculators are out there thinking your stock is overvalued and they're short selling, why don't you just go buy it up? And so he actually did do that. And he went and bought, because they were naked short selling. So he bought more shares than existed, in terms of, ones that he already owned.
Oh, interesting.
And then would go to the brokers and say, okay, I'm calling their bluff. They were trying to short sell here. I just bought them all. And then they would just break the trades and say, oh, yeah, that doesn't make sense. And
yeah,
and so
I've seen
nothing
that.
would happen. They would just break the trades. And so he's like, well, what more can I do? Like, if I don't fight it, it pushes my share price down. I can buy them all up. And then the brokers just say, oh, yeah, sorry, it's a do-over.
Well, the easiest way to fight that kind of thing is a go private transaction, right? And that's literally what Dole was doing. They didn't fight it because of that, because I don't think they understood just how off the ledgers were. But I'm thinking back to my days as an equity research analyst in the 1990s. I was working with a company that was under attack from short sellers, and the CEO just went to the shareholders and said, turn off your securities lending. That's where so many of these shenanigans come up, is in the securities lending markets. And this gets back to one of the things. And so we talked about regulations, some of the things I'm calling balls and strikes on, but I think this particular one was a home run. And the home run I'm talking about is the SEC last week or the week before last now is saying that Wall Street should move from T+2 days to settle securities transactions to T+1. Now, I asked the question, why are we going T+0? We have the technology to go T+0 right now, but I stood up and said, yay, thank goodness, because all these shenanigans we're talking about that I've seen in my career are going to be a lot harder as you shrink that time between the transaction time and the settlement date. And so I'm very much hoping that we get to the point, and this is something I've been working on now for years, almost a decade. Let's get to the point where you actually have digitally issued financial instruments that you can verify are the real thing. You're not buying one of the fake ones. And you can create technology using API calls to call the Secretary of State of Delaware to verify that the share that you're purchasing was validly issued and outstanding. Not a radical concept. We have the technology to do this. Why we're not doing this today is because there's so many, we're going to have to collapse down all those layers of intermediaries. There's so many people who make money off the skimming mechanisms that they've figured out how to use, like what we saw in that Dole Food case, which was admittedly an extreme example, but it exists. And guess what? Those ledger systems are never in sync with each other. This is why we have these fudge factors, these operational just sort of ability for balance sheets not to balance. Now we're coming back to where we started this whole interview. Why is it so important that balance sheets matter? Because these kinds of fudge factors where you're not requiring a reconciliation of a balance sheet in essentially real time, the moment you get away from that, then nefarious actors can capitalize upon them. And it happens every day, unfortunately. People kind of know that there's something off with the financial system, and they just can't put their finger on it because it's subtle, and they're not wrong.
Well, I want to be respectful of Caitlyn's time. Cole, did you have any final question you wanted to ask her?
No, I'm making notes. Like I'm sitting, like I have like literally been sitting here just like making notes. So I'm like, thanks for the education, guys. I'm fired up right now.
Okay. With the thing. So, Caitlyn, maybe the last thing I'll just ask is, where can people, if they're interested in what you're talking about, do you want to point them somewhere specifically so they can learn more either about the work you're doing or just some of these issues in general?
Yeah, follow me on Twitter. Also have a blog with some of those old blog posts, Caitlyn-long.com. And back then I was a Forbes contributor, still technically am, but haven't been as active recently. And then, of course, LinkedIn as well.
Okay, well, great. So, folks, our guest this week has been Caitlyn Long. We hope you learned a lot from her. Caitlyn, thanks so much for your time.
Yeah, good to see you again, Bob, and nice to meet you, Cole.
This concludes another episode of the Founders Forum. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the hosts and for previous episodes, visit foundersforum.io. Thanks for listening.